the average 30-year mortgage rate rising to 5%, homeownership may now be out of reach for millions more Americans. Wall Street Journal explains the impact for potential buyers, sellers, and the housing market. Hi, Michael Chu of 7 Realty here in Fremont, Silicon Valley. We bring timely housing market research to you so you can be an informed homeowner or buyer. Your encouragement is important to us, so like, comment, share, or subscribe to our channel. After years of near record low rates, the party may be over since the mortgage rates are moving back up, and the average 30-year fixed mortgage rate has now broken the 5% barrier. That's a far cry from the rates under 3%, which was the average rate as recently as December. So how important is that rate at about 5%? When it comes to the housing market, it turns out it is pretty important. I'm going to explain why, just how much impact it could have, and why economists don't expect it to crash the market. Let's get into it. Why is 5% an important number? It doesn't seem like much, but when you're talking about buying a house, a couple of percentage points means hundreds of thousands of dollars in just a few months. This year, National Association of Realtors found that higher mortgage rates increased the monthly cost for a median U.S. home by $300 per month. That means average home buyers today will be paying $3,600 more a year than people who bought it in January at 3%. U.S. home buyers are paying an additional $108,000 on a 30-year mortgage for a medium-priced home over the life of the 30-year loan. These numbers were based on a median home price of just under $400,000. With Silicon Valley median home prices at $1.6 million, that number is a whopping more than $432,000 more than in January. What that means for today's buyers, they will either look for homes at a lower price range below their original price point or pay $1,200 more a month. No wonder more than 25% of the buyers in the U.S. are sitting on the sideline now, according to the Commerce Department. Locally, as we have seen in the last month, since late April, there are fewer and fewer buyers out there. That means fewer multiple offers. Like instead of 17 multiple offers, we're now down to 3 or 4. In our neighborhood, which had been selling in one weekend normally, right now we have a house that has been over 2 weekends and still not in contract yet. Of course, it's still a seller's market, but it's slowing down noticeably. Higher rate also change who is able to buy a home. A year ago, a potential buyer with an income of just over $61,000 would be able to qualify for a mortgage on a medium-priced home. With mortgage rates at 5%, that rises to $84,000. Higher rates are already having an impact on the housing market. There has been a significant decline in the number of lower priced homes. For existing home priced between $100,000 and $250,000, sales have fallen by 26% from a year ago. Existing home sales fell 7% in April from the previous month, which is the largest decline in a year. In fact, existing home sales have declined every single month since, again, compared to their levels of the year before. But falling sale prices aren't bringing down prices. They are still rising and at a double-digit pace. That's largely because there's so little supply and because more home sales at higher price points raises the median sale price. The chief economist with the Mortgage Bankers Association, MBA, says, with rates at 5%, MBA is likely to pull back expectations for home sales this year. The National Association of Realtors is also reevaluating their forecast for 2022. Their director of forecasting, Nadia Evangelo, says with a rate average of 5% for the year, 16 million potential home buyers will be priced out of the market, and that includes 2.3 million first-time buyers. If you like this episode so far, please like, comment, share, or subscribe. It really means everything to us, and thank you for viewing. But Evangelo and other economists still are not expecting the housing market to go belly up this year, even with 5% mortgage rate. That's largely because even though buying a home is getting less affordable, so is renting. The average rent in the U.S. rose by 17% February to a record high, according to realtors.com. The other factor is millennials are reaching what economists call peak buying age, and now represents about 43% of the buyers. It is a large generation, and economists expect that to be positive for the housing market for the next couple of years, regardless of what happens with the economic and mortgage rate environment. And finally, there just isn't enough housing. Vacancy rates are at all-time lows across the country, so more people are having to make the choice between sticking it out with sky-high rent or stepping out and coughing up more to buy a home. Evangelo also expects inflation to cool down this year as the Federal Reserve raises rates, and she predicts demand slows down. That should rein in the rapid increase in housing prices and help affordability. There were all expectations for the housing market to cool, so it seems unlikely to end the party. While higher mortgage rates have started to reduce buyer demand, home prices remain sky high as demand continues to exceed supply. The level of existing home for sale is unusually low, pushing buyers into bidding wars. The median new home price rose to $450,000 in April, up 19.6% from a year earlier, the Commerce Department said. More home buyers are opting to pay fees to secure lower rate in the form of rate lock agreement and discount points. A borrower can now buy points at a rate of 1% of the value of the mortgage. Each point lowers the rate by a fraction of a percentage point. Borrowers in April paid an average of $3,134 in discount points and loan origination costs, according to estimates from the National Association of Realtors. That's 31% higher than a year ago. There was a rate quoted near 2.5% last year. This is an actual case. Mr. Paul Eggebel was quoted a rate nearly 2.5% last year when he hit the market. But the completion of his Red Oak, Texas home he's expected to close on last fall was delayed until May this year. He locked in a rate of 3.5% in February, just before rate began their sharp rise. After the 60-day lock expired in April, he paid his lender, J.P. Morgan Chase, about $1,700 to extend it until early May. Mr. Iqbal, who operates an online shoe selling business, also opted to pay about $4,600 for discount points to reduce his rate to 3.25%. His monthly mortgage payments are about $500 lower than they would have been if he had been saddled with today's average rate above 5%. I would still be able to afford the payments, but I would have been really annoyed, Mr. Egbel said. At mortgage lender Neat Loans, about 75% of the customers choose to pay for discount points in the first quarter, up from less than 20% a year ago. They're kind of taking their medicine and making a one-time payment to get back to where things were 30 days ago. Minutes from the Fed's May third and fourth meeting released Wednesday shows that officials discussed the possibility that they would raise interest rate to level high enough to slow economic growth deliberately as the central bank races to combat high inflation. In an interview with the Wall Street Journal last week, Fed Chairman Jerome Powell laid out a relatively high bar to slow down rate increases. This is not a time for tremendous nuanced readings of inflation, he said. We need to see inflation come down in a convincing way. Until we do, we will keep going. I hope this episode helped in explaining how the 5% mortgage rate is impacting the market. Please like, share, or subscribe. And if you still have questions, comment below or reach out to us at 650-753-7787. Texting works the best, and I'll be sure to provide more details to you. Till next time, let's make it a great day.
Just did on a dealer two lot there, guys. A dealer two lot. $1,000 on a two lot. Look, dealer's two lot. $1,000 on a two lot. On a two lot. Boom. Look at that, guys. Crazy, right? Dealer two lot back into the halfback trade. Just taking some monies. Back into the halfback trade.